The median American retirement account balance is $87,000. Not $87,000 per year, $87,000 total. That number represents the person sitting exactly at the 50th percentile in this country, the middle of the pack. And that number represents decades of compounding. Then there is the top 5%. And here's the thing that changes this entire conversation. Being in the top 5% is not primarily about what that number on your statement says. I can show you a man with $1.2 million who will run out of money in 14 years. And I can show you another man with $750,000 who will die with more than he started with. The account balance is the scoreboard. And this video is about the people who stopped watching the scoreboard and started flying instruments. 54% of American households have no dedicated retirement savings. Not low savings, zero. That is from the Federal Reserve's own survey of consumer finances. Of the people who are saving, 58% told Bankrate in their 2025 retirement survey that they're behind where they should be. In fact, only 35% of non-retired adults told the Federal Reserve in their 2025 SHED report that their retirement savings were on track. That number was 40% in 2021. It's moving in the wrong direction. Meanwhile, somewhere, right now, someone is telling their spouse they're pretty much set because their 401k has been active for 7 years. Their balance is $42,000. Their spouse is nodding. The 3 signs I'm about to show you are not about income. They are not about luck. They are not about which stocks you bought in 2020. They're about 3 specific instruments that the top 5% use to fly their retirement instruments, that the overwhelming majority of Americans building toward retirement have never installed, and in some cases have never heard of. One of them is going to tell you something about the first 10 years of retirement that your financial advisor has almost certainly never mentioned. And that redefines what having enough actually means. In a few minutes, I'm going to show you a risk supported by research from Wade Faw, professor of retirement income at the American College of Financial Services, that has nothing to do with how much you save, nothing to do with your investment picks. And according to his published research, it determines approximately 77% of whether your retirement plan survives. Stay with me, because that number changes everything. Here is the thesis. Being in the top 5% of retirement preparedness is a systems problem, not a money problem. The people who cross the finish line are the people who built the right instruments before they needed them. 3 instruments. 3 signs that, if you have them, put you in a fundamentally different category than 95% of people who are working toward a retirement right now. I'm going to give you the second most important sign first, then the most important, because that's how you stay until the end. Not because I'm gaming you, but because understanding the second sign makes the first sign make complete sense in hindsight. The central metaphor I keep coming back to when I think about this is the difference between flying by sight and flying instruments. Flying an airplane by sight is legal in clear conditions. In daylight, short distances, no clouds. It's called visual flight rules. You look out the window, you see the horizon, you keep the nose level, it works. Until it doesn't, the moment a cloud appears, you need instruments airspeed, altitude, rate of climb, heading. Without them, you lose orientation inside 60 seconds. You think you're climbing, you're descending, you think you're level, you're in a spiral. The plane doesn't know you're disoriented. It just follows physics. Most people fly their retirement by sight. Balance looks okay. Contribution is happening. Markets are up. Fine. The 3 signs in this video are your instruments. Not because I think disaster is coming, but because clouds are unpredictable, and the pilots who make it through turbulence are the ones who are already flying instruments before the weather changed. Before we get to the sign that most people find genuinely unsettling, let me start with one that sounds almost too simple, and then show you the mechanism hiding underneath it that almost nobody has mapped. Goldman Sachs published their 2025 retirement survey in October of last year. They surveyed 5,102 working and retired Americans. The specific finding that matters here is this. People with what Goldman calls high financial grit retire with 49% more in savings than people with low financial grit, even when their incomes are identical. Read that again. 49% more. Same paycheck, same tax bracket, not different bosses, not different cities. Identical income. and yet 49% more retirement wealth. Goldman defines financial grit as a combination of three very specific behaviors: contributing consistently, regardless of market conditions, reinvesting dividends automatically, staying invested when the news makes staying invested feel irrational. None of those three things require above average intelligence. None of them require a sophisticated understanding of macroeconomics. They require a system that removes the decision from the human being and hands it to automation. Here's why that matters. 70% of workers in Goldman's survey reported at least some stress or neutrality when managing retirement savings. Stress is statistically the moment when savers sell, or pause contributions, or move to bonds. Each of those decisions, in the moment, feels responsible. Each of them compounds silently against you for the next 20 years. There's a man I'll call Paul. He's 44 years old, works in marketing, makes $110,000 a year. His colleague David makes the same $110,000, has the same 401k option, the same employer match. Paul has checked his account balance during every significant market event since 2016. He didn't sell everything during 2020, but he moved a portion into bonds in February. He reduced his contribution in 2022 when inflation was running hot and things felt tight. Each decision felt reasonable at the time. Each one cost him something he cannot recover. David set up automatic contribution escalation when he turned 35. His contribution increases 1% every January 1st. He doesn't think about it. He doesn't watch his balance during corrections. Not because he's emotionally superior to Paul, because his system requires zero heroism to function. The money moves before sentiment has a chance to override it. Goldman found that access to a workplace plan is associated with a 29% higher savings to income ratio over time, and that early savings habits add another 14% on top. But the mechanism behind all of it is automation. Money that moves automatically never has to survive a Tuesday when the market is down 3% and you're feeling anxious about your mortgage. This is not a discipline story. This is a systems design story. The top 5% are not more disciplined than everyone else. They have just built better defaults. Fidelity's data shows the average total contribution rate, employee plus employer, hit a record 14.3% in 2025. BlackRock's 2025 retirement survey found the median savings rate actually dropped from 12% in 2022 to 10% in 2025. The people pulling the average up are pulling very hard. The gap between active systematic savers and everyone else is growing. You think the problem is that people don't know they should save more. But actually the problem is that the decision to save is made every single month, in competition with every other financial pressure a person is experiencing. The top 5% removed that competition. They made the decision once how much to save and that it increases automatically, and then they took the decision off the table permanently. If you have automatic escalation set up on your 401k, you are flying the first instrument. If you don't, everything else we talk about today is built on a foundation that has a known structural flaw. By the way, hit subscribe if you find this useful, otherwise the YouTube algorithm may never show you my videos again. In the next section, I'm going to show you the retirement risk that affects everyone who has a portfolio and plans to withdraw from it, is almost never explicitly addressed in a standard financial plan, and has nothing to do with what the market does on average. It has everything to do with what the market does first. This is where it gets genuinely uncomfortable. And I say that not to be dramatic. I say it because the research is uncomfortable, and I'd rather you know about it now than find out about it at 63. Here's the parable. 2 pilots, identical planes, same fuel load, same destination, same weather forecast at takeoff. 300 miles out, a storm system neither of them predicted rolls in. Pilot 1 hits the storm in hour 1, low on speed, fully loaded, not yet at altitude. He uses fuel just to maintain stability, burns through reserves, and lands 80 miles short of the destination. Pilot 2 hits the same storm in hour 4, established altitude, speed managed, reserve fuel intact. He lands comfortably. Same storm, same planes, same fuel, completely different outcomes because of when the storm arrived relative to where they were in the flight. This is sequence of returns risk, and it is the single most underappreciated concept in all of retirement planning. Here is the mechanism. During your working years, when the market drops 20%, You lose 20% of your current balance. Painful, but recoverable. You keep contributing at lower prices, which actually improves your long-term cost basis. Your future self benefits from today's down market. The math works partially in your favor when you are still adding fuel. But the moment you start withdrawing, that math flips completely. Now, when the market drops 20%, you are selling at lower prices to fund your expenses. Every dollar you pull out during a down market is a dollar that will never participate in the recovery. You aren't riding the dip. You are selling into the dip, extracting cash to pay for groceries, and expecting the remaining shares to somehow make whole what was lost. They cannot. There are not enough of them left. Research by Wade Paugh, a professor of retirement income at the American College of Financial Services, quantified this directly. The compounded return the first 10 years of retirement accounts for approximately 77% of the final retirement outcome. Not a majority, not most, 77%. Established in your first decade of withdrawal. 2 retirees, Lucky Larry and Unlucky Lucy. Both retire with $1 million. Both plan to withdraw $50,000 per year, adjusted upward 3% annually for inflation. Both portfolios earn the exact same average return of 7% over 10 years. The only difference is the order of those returns. Larry gets the good years first. Lucy gets the bad years first. After 10 years, according to research from financial planning firm Enough FP, Larry's portfolio is healthy, worth close to $1.2 million. Lucy's portfolio, despite generating the exact same average annual return, is worth approximately $535,000. She is on a trajectory to run out of money before the end of her retirement. Larry is not. Neither of them made a single different investment decision. Neither of them got different returns on average. The only difference was sequence. That is not a hypothetical. That is math. Morningstar's 2025 research confirmed what Fow's work had already established. Retirees who experience poor returns in the first 5 years and do not adjust their spending are far more likely to exhaust their savings entirely. A 2022 Morningstar report found that a 15% portfolio drop in year 1, combined with just a 3.3% withdrawal rate, increased the odds of depleting the portfolio within 30 years by 6 times compared to someone whose first year of retirement was positive. 6 times. Not 6% worse, 6 times more likely to go broke on the same portfolio with the same average return. And here is the layered problem. The standard financial plan does not model this. Your advisor runs a Monte Carlo simulation, finds a 70 or 80% probability of success, and sends you a PDF. That simulation is built on average annual return, not sequence. You are looking at the average score of your entire flight, not whether you're about to hit turbulence in hour 1 when you're still at low altitude with full withdrawal pressure. The 4% rule, by the way, it was invented in 1994 by financial planner William Bengen in a paper for the Journal of Financial Planning. 1994. Bengen himself revised it upward. He told CNBC in 2025 that retirees who stick to exactly 4% are probably cheating themselves a little bit. Morningstar's 2025 forward-looking model puts the base case safe withdrawal rate at 3.9% for a balanced portfolio, and notes that flexible dynamic withdrawal strategies can push that to approximately 6%. The 4% rule is not wrong. It is just a floor created during the Clinton administration that the entire financial advisory industry adopted as gospel and never meaningfully revised. Amy Arnott, a portfolio strategist with Morningstar Research Services, describes the first 5 years of retirement as the danger zone for sequence risk. Your portfolio balance is near its peak. You've started pulling from it. Losses compound against you at the worst possible time because you're selling the most shares when they're worth the least. Now here's the practical fix, the bucket strategy. Keep 1 to 2 years of living expenses in cash or short duration instruments separate from your invested portfolio. This is your landing gear. When the market drops in year 1 of retirement, you fund your expenses from cash instead of selling equities at the bottom. You let the portfolio recover. You delay claiming Social Security as long as possible, ideally to age 70, which shrinks the amount you need to pull from the portfolio during the danger zone. And you use a flexible withdrawal strategy. Spend less in down years, spend more in up years, rather than treating any fixed percentage as an inviolable rule. Here is the real insight. Two people can have identical balances at retirement, identical investment mixes, identical average returns over the following 20 years. And one of them will run out of money, and one of them will not, entirely determined by whether they built sequence risk management into their structure before they needed it. 57% of retirees told Clever Real Estate in their 2026 study that they had waited until age 30 or later to start saving for retirement, and 31% didn't start until age 40. They are already fighting time. Adding an unmanaged sequence risk exposure on top of a late start is a compounding problem that most standard retirement plans will never model for you. The top 5% understand that sequence risk exists. They have built something to defend against it. Everyone else is hoping their retirement does not coincidentally start at the beginning of a bear market. Here's the part that never appears in a standard retirement projection. Knowing these numbers and building a financial structure around them are two completely different things. I know that from my own experience. I had access to the sequence of returns research for years before I actually mapped it against my own withdrawal timeline and built a buffer around it. So I built a book. It's called The Exit Code. 8 chapters built entirely on 50 years of actual retirement data, not opinion, not motivation, not promises. Inside, I cover the dynamic withdrawal method that replaces the 4% trap, the 58%. Rule the data on how often people are forced out of work before they plan to retire, and the buffer size that protects against it, and the sequence of returns buffer strategy with the specific math for your portfolio size. If you're within 20 years of your intended retirement date, this framework changes the conversation from how much do I have to what is my specific exit structure. You can get it through the link in the description for less than you would spend at a restaurant with a decent wine list. And I'll tell you what I tell everyone. Every month, you don't have this framework. You're building a flight plan without a sequence risk instrument. The math on that compounds against you in the same direction as fee drag, quietly, invisibly, and for a very long time. Stay with me, because the third sign is the one that triggers the most visceral reaction once people actually run the numbers. You've got behavioral automation. You understand sequence risk. Now here is the third instrument. And it's the one where the top 5% are flying on data that most people have never specifically calculated for their own account. Fees. More specifically, fee drag. And I'm going to show you exactly what it costs in real dollars because the percentage number is engineered to feel small. The standard financial advisor fee is 1% of assets under management per year. 1%. That feels negligible until you do the actual math with actual time horizons. Here is the calculation. Take a $500,000 portfolio. Assume 7% annual returns. No advisory fees whatsoever. After 20 years, according to research published at truthify.com, that portfolio is worth approximately $1.93 million. Now add a 1% annual fee. Same portfolio, same 7% gross return. After 20 years, approximately $1.6 million. The difference is $330,000. Not $330,000 that went to bad investment picks. Not $330,000 that went to a market crash. $330,000 that went to fees. And those fees compounded against you in reverse every year. The fee reduces the base on which the next year's growth is calculated. It doesn't just cost you the fee, it costs you every dollar that fee would have generated over the remaining investment horizon. Over 30 years, research from financegrowthtools.com found that a 1% annual advisory fee can reduce your final portfolio value by 28%, not $28,000, 28% of everything you built. If you're on pace to retire with $1 million under a 1% fee structure, you should have had $1,390,000. That $390,000 is not missing because the market failed. It's missing because of fees that compounded silently for decades. And here is where it compounds further. The standard 1% AUM fee is typically layered on top of fund expense ratios. If your advisor has placed you in actively managed mutual funds with, say, a 0.6% average expense ratio, your total annual fee drag is 1.6%. Research from White Cloud Wealth Management shows that a 2% total fee structure over 25 years costs approximately $1 million in lost wealth relative to a low fee equivalent portfolio. $1 million, same starting capital, same gross returns, different fee structure. Your advisor, by the way, is deeply focused on growing your wealth. He thinks about it every Tuesday between the 14th and 15th hole. Very committed professional. There is a man I'll call Robert. He ran a small construction business for 20 years. By the time he was 52, he had accumulated $650,000 across a rollover IRA and a brokerage account. He had been with the same financial advisor since he was 34. Good relationship, trusted him, never looked specifically at the fees. When Robert finally sat down and added it up, the 1.1% AUM fee plus the average expense ratio of his mutual fund holdings, he was at approximately 1.7% total annual drag on $650,000. That's roughly $11,000 per year. In a year where his portfolio returned 8% gross, he was netting 6.3%. When we model the compounding cost of that fee drag over the previous 18 years of the relationship, including the opportunity cost of money that could have stayed invested and compounded, the total reached over $180,000. Not from bad picks, not from market timing, from fees he had never specifically audited. Robert renegotiated. He moved into index funds within the same account structures, dropping his average fund expense ratio from 0.6% to 0.07%, and shifted to a flat fee arrangement with his advisor for actual planning work. His total annual cost dropped from roughly $11,000 to just under $4,000. His balance did not change overnight, but his trajectory changed because he had installed the instrument and was now flying on actual numbers, not assumptions. The framework for auditing this is 3 questions. 1, what is your all-in annual fee as a percentage, meaning your advisor fee, plus the average expense ratio of the funds you hold? Not just one or the other, both. 2, can you identify a specific measurable benefit that fee is generating in actual tax savings, return improvement, or planning outcomes, not in vague terms like peace of mind? 3, have you modeled what a low-cost equivalent would look like over 20 years using your current balance and contribution rate? If you answered no to any of those 3, you don't have an instrument. You have a blindfold on the fuel gauge. This is where the subplot I've been building toward resolves. I mentioned earlier a friend, business owner, late 40s, called me after getting a quarterly statement. The number looked good. He sounded calm. I asked him 3 questions. First, automatic escalation. He had been contributing the same fixed dollar amount for 6 years. He'd meant to increase it when things get more comfortable. This is the Goldman Sachs financial vortex problem. Rising housing, healthcare, childcare, and college costs have been outpacing wage growth since the early 2000s. More comfortable is a moving target that functionally never arrives. The system cannot wait for emotional permission. Second, sequence of returns buffer. He looked it up after I mentioned it. He had not built one. His plan was to be conservative with withdrawals when he retired at 62. That is a vague hope shaped like a plan, not a structure. Third, total fee structure. He knew his advisor charged 1%. He did not know his fund expense ratios. When we added them, he was at approximately 1.4% total. On his $580,000 portfolio, that was about $8,100 per year. His exact reaction, that's more than my car payment. Over the following month, he did 3 things. He set up 1% annual automatic escalation. He allocated 18 months of projected retirement expenses into a liquid cash buffer, separate from his portfolio as a sequence risk cushion. And he renegotiated to a flat fee planning model, moved into lower cost index funds, and cut his total annual fee drag to under 1% with full transparency into every component. His balance didn't change. His retirement date didn't move. But for the first time since he opened those accounts, he was flying instruments. Let me give you a concrete case study that makes this tangible. Maria. 48 years old, earns $95,000 a year, has $280,000 across her 401k and a Roth IRA. By Fidelity's benchmark, she should have approximately $570,000 by age 56 times her salary. She's behind the benchmark. But here's what the benchmark doesn't capture. Maria has automatic contribution escalation set up 1% per year, running for 4 years. She does not look at her balance during corrections. Goldman Sachs would call her a high financial grit saver. Sign 1. Maria read about sequence of returns risk 2 years ago and built a specific cash buffer, $48,000 in a high-yield savings account designated as her. First 18 months of retirement emergency layer. It is not part of her retirement number. It is insurance against the danger zone. Sign 2. 2 years ago, Maria moved to a fee-only advisor after calculating her previous arrangement was costing 1.6% annually. She is now in index funds averaging 0.07% expense ratio, plus a flat annual planning fee of $3,000. Total cost, approximately 1.14%, but she can name every component and the value it delivers. Sign 3. Is Maria in the top 5% by balance? Not yet. She's behind Fidelity's benchmark. But she is flying with top 5% instruments on a trajectory that most people with $500,000 and zero instruments cannot match. This is the thing about the scoreboard. It tells you the score at this specific moment. It does not tell you which team has the better system, the better structure, or the better route to the final whistle. The top 5% stopped watching the scoreboard and started reading their instruments. And that is not a metaphor for being smarter. It is a metaphor for building something that works even when you are not watching. The Federal Reserve data shows 54% of households have nothing saved. The median balance is $87,000. The magic number Americans believe they need in 2026 to retire comfortably, according to Kiplinger, is $1.46 million. That is a gap of $1.37 million. And 79% of working-age Americans, nearly 4 in 5, believe the country is in a retirement crisis, according to the National Institute on Retirement Security. They are not wrong. But the crisis is not primarily that people are earning too little. The crisis is that people are flying by sight and calling it a retirement plan. 3 specific takeaways from this video. Not generic, exactly calibrated to the 3 signs. First, if you do not have automatic contribution escalation active on your 401k, set it up before you close this tab. 1% per year. Goldman Sachs quantified what happens when the behavioral system is removed from human decision-making. 49% more retirement wealth on identical income. That number does not require a better job or a different market. It requires a setting you can change in 10 minutes. Second, identify your sequence of returns buffer before you identify your retirement date. Specifically, calculate how many months of living expenses you would need in cash or short duration instruments to avoid selling equities during a 15% portfolio decline in year 1 of retirement. Morningstar's 2025 research confirmed that surviving the first 5 years of retirement without forced equity selling is the single largest structural predictor of whether a 30-year retirement plan holds. Build the shield before you need it. The cost of holding cash as insurance is real and visible. The cost of not holding it is invisible until it isn't. Third, audit your all-in fee structure within the next 2 weeks. Add your advisor fee to your average fund expense ratio. Calculate the total as a percentage of assets. Then model what a 28% reduction in your final portfolio value would mean in your specific case. Because that is the historical cost of an unexamined 1% fee drag over 30 years. You deserve to know the number. The instrument requires you to look at it. Lazy investing built more fortune than crypto memes. The best time to install these instruments was a decade ago. The second best time is before your next quarterly statement arrives and you go back to watching the scoreboard.